The Psychology of Investing. Chapter 11. Cognitive Dissonance in Portfolio Maintenance. A bad trade is rarely hard to exit just because of the money. It becomes hard because every trade began with a reason, and when the position turns against you, that loss can feel like a challenge to your judgment. Instead of simply asking whether the investment still deserves a place in the portfolio, the mind starts trying to protect your self-image. That creates a very uncomfortable tension between "I made a smart decision" and "this trade is going badly."
To reduce that discomfort, people often reach for a story that makes holding feel safer than reviewing. The danger is that emotional relief can start to replace honest evaluation.
Regret is often what gives those stories their power. In the moment, phrases like "the drop is temporary" or "the market is irrational today" can sound thoughtful, but they often serve an emotional purpose more than an analytical one. They help you avoid the sting of admitting that the trade is not working. Another common move is quietly changing the time frame, turning a short-term trade into a long-term investment, only after it starts losing money. Waiting to get back to break-even can feel disciplined, but break-even is usually about your feelings, not the market's facts. A useful review asks what has changed in the business, the thesis, or the risk. A regret-driven review asks what story lets you postpone the pain. Defensive stories are dangerous because they rarely stay small. Once you begin protecting the trade, you begin drifting away from the original plan that was supposed to guide the decision. Hope starts to take the place of rules, and what could have been a manageable exit becomes an open-ended delay. Meanwhile, the position keeps using capital that could be deployed elsewhere, and it keeps taking up mental attention as well. Over time, the quality of the decision often gets worse, not better, because each day of delay creates more pressure to justify the earlier delay. This is how a single poor trade can become a larger process problem. The real cost is not only the loss itself, but the weakening of discipline around it. The earliest warning sign is often a feeling, not a spreadsheet. You may notice tension, defensiveness, or the urge to check the price over and over, as if constant monitoring will somehow fix the discomfort. Sometimes it shows up as urgency, a sense that you must do something immediately. That feeling matters, but not because it is giving you a trading signal. It matters because it tells you reality is no longer matching your expectations. If you can recognize that discomfort early, you create a chance to pause before reacting. In practice, the emotion is useful data, not a command. One of the simplest ways to interrupt this pattern is to put the story into words. When you write down the explanation you are giving yourself, it becomes easier to examine and harder to obey automatically. You may notice phrases like, "It's only a loss if I sell," or "It just needs more time." Written down, those lines are easier to separate from the facts of the trade. Facts might include the current price, the original thesis, whether the catalyst still exists, and whether risk is still acceptable. The key is to see that a reflex is not a plan. Once the story is visible, you can judge it instead of being carried by it. At that point, the best anchor is the plan you made before emotion took over. Ask why you entered the trade, what target or exit rule you set, how much risk you were willing to take, and whether you had rules around events like earnings. Those pre-committed rules are valuable because they were created when your thinking was calmer. If today's facts still match the original thesis, then holding may be reasonable. But if the trade has violated the conditions you set in advance, your hope of avoiding regret is not a good reason to stay. The purpose of returning to the plan is not to be rigid for its own sake. It is to protect decision quality when feelings are loudest. Evidence has to come before action. If the trade has already hit the exit point you defined in advance, the disciplined response is to follow it rather than move the rule under stress. Investors often weaken their own system by rewriting limits in the heat of the moment. If there truly is new information that changes the case, then write that new reasoning down before placing the trade. That step forces you to ask whether the change is based on evidence or on self-protection. It also creates a record you can review later. Good analysis may still lead you to hold, reduce, or exit, but the sequence matters. Observe, write, decide, then act. Mia's example shows what this looks like in practice. She bought 100 shares at $50, investing $5,000, and she wrote 2 clear rules before entering. Sell if the stock falls 15% to $42.50, and do not hold through earnings. When the stock dropped to $42, her emotions told her to wait, but her written process said the trade had already violated both rules. She sold for $4,200, locking in an $800 loss. That is never pleasant, but discipline is often uncomfortable in the short run. When the stock later fell to $35, her rule-based exit had also prevented another $700 of loss. The lesson is not that every exit will look smart immediately, but that good rules protect both capital and judgment. There are several rationalizations worth learning to recognize quickly. One is confusing hope with analysis, where wanting a rebound starts to feel like a real investment thesis. Another is calling something a lesson before any behavior has actually changed, because insight without changed action is mostly self-soothing. Blaming the market is another common defense. Sometimes the market is chaotic, but that doesn't remove the need to review your own process. Seeking validation can be just as misleading, especially when you go looking for people who will reassure you rather than challenge your thinking. When these patterns appear, the question is not whether they sound reasonable. The question is whether they are helping you get closer to the truth. A short, written checklist can make this much easier. Start by writing the story you are telling yourself as plainly as possible. Then write the original plan you had before the trade became emotional. After that, compare the current facts with the exit rule or thesis you set in advance. Finish with one clear action sentence, something simple like sell and review, or hold because thesis remains intact and rule has not been triggered. The purpose is not to force every losing position into a sale. It is to make sure the decision comes from facts and rules rather than from regret avoidance. Cognitive dissonance does not only show up in single trades. It also appears in how investors review their overall results, especially when they focus on the parts of the record that feel flattering. Cherry-picking performance data means highlighting a great trade, a great month, or a favorable comparison, while quietly ignoring the rest. Someone might talk often about their biggest winner, but rarely mention the several losers around it. Or they may choose the benchmark that makes their results look strongest, instead of the one that is most appropriate. This habit feels harmless because every statement may be technically true, but the overall story becomes misleading because the full record is missing. Investors do this because a complete record can be uncomfortable to face. Looking at the whole account may reveal poor timing, unnecessary risk, or results that were weaker than the investor wants to believe. Selective review protects confidence in the short term by narrowing attention to the evidence that feels good. It helps preserve the image of being competent and in control. The problem is that confidence built on omission is fragile and often expensive. When losses, weak periods, and mistakes are pushed out of sight, judgment becomes less honest. The account may feel safer than it really is, simply because the uncomfortable parts were edited out. Cherry-picking does more than create an optimistic story. It distorts how you judge skill, risk, and strategy quality. A rebound can look impressive if you only look at the recovery and ignore the sharp drawdown that came first. A weak benchmark can make an average strategy appear exceptional. In a strong bull market, many portfolios rise together, so returns alone may reveal very little about stock-picking skill. And one standout winner can dominate your memory, even if several smaller losers quietly cancel much of it out. Without the full context, it becomes easy to mistake luck, market conditions, or selective framing for ability. That distortion matters because it shapes future behavior. If you learn only from favorable evidence, you may keep using a strategy that is not really working. Risky habits can start to feel justified because the review process is filtering out the warning signs. Over time, discipline weakens because the feedback loop is broken. You stop getting an honest picture of what helped and what hurt. That also means better alternatives may be overlooked since the current approach appears stronger than it is. A biased review does not just protect your feelings, it trains poor decisions. A fair review includes the whole picture. That means every trade, not just the winners you remember most clearly. It includes strong market periods and weak ones, because a strategy should be judged across more than one environment. It includes fees and trading costs, since investors keep net returns, not gross ones. It also includes unrealized losses and open positions, because money tied up in a losing holding still affects your wealth. And finally, it uses an appropriate benchmark, one that actually matches the kind of exposure you took. Honest performance review is less about finding highlights and more about seeing the portfolio as it really behaved. A repeatable process helps make that honesty easier. Decide in advance what period you will review, such as monthly or quarterly, so the window is not chosen after the fact. List every trade and every current holding, not just the ones you feel like discussing. Start with total portfolio performance before diving into individual stories. Then compare that result with a broad benchmark over the same time period. It also helps to check performance across different market environments, because a process that looks good in one climate may struggle badly in another. The more consistent the review structure, the less room there is for emotion to edit the evidence. The cleanest starting point is one honest number for the full account. Before discussing your best ideas, ask how the total portfolio actually performed. That calculation should include money added and withdrawn, so you are not confusing contributions with investment skill. It should also keep disappointing trades in the record rather than silently excluding them. Unsold losing positions count too, even if they are easier to mentally postpone because the loss is unrealized. This approach is less exciting than telling success stories, but it is much more informative. It gives you a base reality before any interpretation begins. Priya's account is a good example of the difference between a trade story and a portfolio story. She felt skilled because one technology stock rose 12% after she bought the dip, and that success became the center of her narrative. But the full account looked different. A utility stock fell 5%, a retail stock fell 15%, and several other holdings were flat. When everything was counted together, her portfolio returned only 2%. Over the same period, the S&P 500 returned 4%, which meant her overall results lagged a simple broad benchmark. One winner made her feel talented, but the whole account told a more modest truth. What changed for Priya was the order of review. She stopped beginning with her favorite trade and started with total account return for the full period. Then she compared that number with a broad index over the exact same window. Only after that did she look at individual holdings to ask whether her stock selection had added value or simply created stories. Repeating that sequence each time made the comparison more objective. It also helped her separate feeling good about a few calls from actually outperforming. Benchmark first is not exciting, but it is a very effective antidote to self-deception. Cherry-picking often hides inside excuses that sound perfectly reasonable. Using an easy benchmark can make mediocre results look strong. Looking only at a short favorable stretch can hide the uneven record around it. Ignoring fees and trading costs overstates what the strategy truly delivered. Leaving out unrealized losses creates the illusion that open positions do not matter yet, even though they already affect your wealth.
Reviewing only bull market periods creates another false impression, because many weak processes can look successful when the whole market is rising.
These traps are common because each one protects confidence while weakening accuracy. Another way cognitive dissonance affects portfolio maintenance is through the endowment effect. Once we own something, we tend to value it more simply because it is ours. In investing, that means a stock or fund can start to feel special, even when nothing about the underlying investment has changed. The market value may be the same as it was for any other buyer looking at it. But our emotional value rises because we have a relationship with it.
That attachment can quietly distort sell decisions. As a result, weak positions often remain in the portfolio longer than they deserve.
This matters most when the original reasons for owning a position have weakened or disappeared. A stock can feel very different once it is sitting in your account than it did when it was just one option among many. Selling may suddenly feel much harder than making a fresh buy decision would feel. That is why an investor may continue holding something they would never choose if they were starting from cash today. The issue is not just normal market volatility.
It is the extra emotional weight created by ownership itself. When that happens, attachment begins to influence the decision more than current facts do.
A simple question can expose this bias quickly. Would I buy this today at the current price? The power of that question is that it asks you to step outside the fact of ownership. You answer as if you were beginning with cash and had to make a fresh choice. If the honest answer is yes, then continuing to hold may be reasonable. But if the answer is no, it is worth pausing, because resistance to selling may be coming more from attachment than from analysis. This question does not force an automatic sale. It helps reveal whether ownership is changing your standards. The pattern usually unfolds in a familiar way. You buy for a sensible reason, and at first the decision is just another portfolio choice. Over time, ownership adds a subtle sense of personal connection, so the holding begins to feel like something you have, rather than something you are continually choosing. Then facts change, or a better opportunity appears, but selling starts to feel painful. Because that discomfort is unpleasant, action gets delayed. The result is that capital stays stuck in a holding you no longer truly want. The important point is that this is not always optimism. Sometimes you know you would prefer something else, and still hesitate to act. The real cost here is often opportunity cost. Keeping an unwanted holding does not just preserve downside risk. It also prevents that money from being used in a stronger way elsewhere. Every dollar in the portfolio has an alternative use, whether that is a better investment, a broad index fund, more diversification, or even debt reduction. A weak holding can quietly block those alternatives while giving very little in return. Investors often focus only on whether the current position might recover, but the better question is what that same capital could be doing instead. The missed alternative is part of the cost, even if no further loss occurs. Priya's situation makes this concrete. She bought 100 shares at $50, investing $5,000, and later watched the position fall to $3,200.
At some point, she realized something important. If she were looking at the market fresh that day, she would not buy that stock at all. She preferred a healthcare ETF instead. Yet selling still felt personal, because she already owned the shares and had lived through the decline with them. That emotional attachment made the old position feel more meaningful than the alternative. Her decision problem was no longer just about forecasts. It was about separating present choice from past ownership. What helped Priya was changing the question. She stopped asking whether the stock might eventually recover, which kept her attention trapped in the old holding. Instead, she asked where the $3,200 should go now. Framed that way, the decision became a current, capital allocation choice, rather than a personal referendum on the past. If that money were cashed today, she would choose the healthcare ETF. Once she saw the situation clearly, she sold the stock and reallocated based on that answer. Ownership was no longer treated as a reason to keep the asset. You can turn that idea into a practical rule. Look through your portfolio for a holding you have owned for more than 6 months. Choose one that, if you are honest, you would not buy today. Write down its current market value so the decision is anchored in present reality rather than in the original purchase price. Then name one investment or one use of cash that you would rather own instead. The rule is simple. If I would not buy it today, I should seriously consider selling it today. It is not a perfect law, but it is a powerful exercise for reducing attachment and increasing objectivity. Because these decisions can feel emotionally loaded, a short pause can help. Waiting 24 hours creates some distance between genuine new information and the discomfort of letting go. During that pause, review your notes and ask what facts have actually changed. Has the business improved, or are you simply struggling with the feeling of selling something you already own? That distinction matters. If ownership is driving the hesitation, the pause helps expose it. Then you can decide whether to follow through based on evidence rather than reluctance. Several habits tend to hide the endowment effect. One is confusing attachment with long-term discipline, as if refusing to sell always proves patience. Another is waiting to get back to even, which gives the purchase price an importance it does not deserve. Investors may also treat ownership itself as evidence of quality, almost as if having chosen the position once proves it still belongs in the portfolio. Opportunity cost is often ignored because it is less visible than a price chart. And many delays happen for a simple reason. Selling feels uncomfortable, so the discomfort gets dressed up as analysis. Recognizing these patterns helps you see when emotion is pretending to be discipline. Rational portfolio maintenance asks every holding to keep earning its place. Emotional value and market value are not the same thing, and good review requires separating them. A current holding should be judged by the same standard you would use for a new purchase. That means asking whether you would buy it now, whether this is the best use of the capital today, and how it compares with available alternatives. Sometimes the answer will support keeping it, and sometimes it will support replacing it. The point is not constant trading. The point is that ownership alone is never a valid investment thesis. All of this leads to a deeper skill in investing, learning how to face mistakes without turning them into a judgment about yourself. Losses are part of the game, even for thoughtful and disciplined investors. A bad outcome is not proof that you are incapable, careless, or doomed to fail. But many people feel that way before they have even reviewed what happened. The first response often shapes everything that follows. If you react with self-attack, thinking narrows. If you react with steadiness, the loss becomes information you can actually use. Self-blame becomes costly because it is another response to cognitive dissonance. The mind holds two uncomfortable ideas at once.
I am a capable person, and I lost money. One reaction is to attack yourself and conclude that the loss says something terrible about who you are. Another is to defend the decision so aggressively that you stop seeing the trade clearly. Both paths damage judgment, just in different ways. Self-attack can make you fearful, hesitant, or desperate to avoid future embarrassment. Defensiveness can keep you trapped in a bad position. Either way, the result is worse decisions layered on top of the first one. The central skill is to separate the action from your identity. Saying, "I sold too early," is very different from saying, "I am a terrible investor." The first statement describes a behavior that can be examined and improved. The second creates shame, and shame tends to shut down learning. When people feel their identity is under attack, they usually become defensive, avoidant, or overly harsh with themselves. None of those reactions helps them understand the trade. Clear improvement starts when the mistake is described as a decision in a specific context, not as a verdict on the person who made it. That is why the first step after a painful trade is not analysis. It is pausing the emotional reaction. Regret, panic, embarrassment, and urgency can all create pressure to act quickly just to feel relief. You may notice stress in your body, repeated price checking, or an impulse to explain the loss away immediately. Instead of obeying that rush, try naming the experience more gently. "I am having a thought about a loss." That wording creates a little psychological distance. It reminds you that the thought is happening,
but it is not the whole truth about you or the trade.
A short pause often protects the quality of everything that comes after.
Once the emotional surge settles, review the facts in neutral language. Write down the entry, the current or exit price, the size of the position, and the reason for the trade. Keep the wording descriptive rather than judgmental. "The stock fell after weak guidance" is useful. "I blew it" is not. Then compare what you expected with what actually happened. Did you expect earnings growth, a catalyst, a rebound, or market support? Where those expectations diverged from reality is usually where the lesson lives. This step turns vague regret into something specific enough to learn from. From there, the goal is not to invent 10 improvements. It is to identify one process issue and one practical change. Maybe you ignored a position size limit, failed to define an exit, or averaged down without rechecking the thesis. Choose a single correction you can actually apply. Then pair that with a self-compassionate statement that keeps you open to learning. Something like, "I made a mistake, and I can improve my process." That is not letting yourself off the hook. It is taking responsibility in a form that supports clear thinking. Self-attack makes discipline brittle, while honest self-respect makes it more sustainable. Maria's losing trade shows how this works. She bought 100 shares at $50 because she expected a contract announcement to push the stock to 65 within 3 months. When the contract was delayed, the original catalyst weakened, but she kept holding. Eventually, she sold at 25, turning the position into a $2,500 loss. Her first reaction was harsh self-criticism, which is a very human response. But the more useful review showed that the real problem was not her worth or intelligence. The problem was process. She continued holding after the reason for the trade had clearly faded. Maria's review uncovered a mismatch between the trade thesis and the holding period. She expected a quick catalyst-driven gain, but ended up holding the position for 11 months as conditions worsened. What was missing was not confidence or talent. It was a rule for an exit, or at least a review date, tied to the original event thesis. So she created a new rule. Event-driven trades need a predetermined deadline.
If the catalyst does not happen by that point, the position must be reviewed or closed. That kind of rule turns pain into structure. It also helps her respect the lesson without turning it into a personal attack. This kind of review works best as a habit, not as a one-time rescue. Whenever a trade triggers regret, use the same structure. Write the trade in neutral terms. Name the exact self-blaming thought. Describe the gap between expectation and reality. Set one concrete process change and finish with one self-compassionate statement. Repeating this process matters because it gradually retrains the mind. Instead of moving automatically from loss to self-attack, you build a path from loss to review. Over time, that makes it easier to stay honest without becoming harsh. The consistency is what turns insight into emotional skill. There are a few traps that can weaken the review. Skipping the emotional pause often means the analysis is still being driven by distress. Using self-compassion as an excuse is another mistake. The goal is clarity and responsibility, not avoiding accountability. It is also unhelpful to review only large losses, because smaller decisions reveal patterns too. Many investors judge outcomes instead of process, praising lucky wins and condemning reasonable losses. And insight is wasted if it never becomes a rule or behavior change. A good review is honest, neutral, and tied to what you will do differently next time. With that foundation, we can take one final step, turning losses into a source of growth. A growth mindset does not make losses feel good, and it does not pretend they are painless. What it changes is what happens after the pain arrives. Shame, regret, and defensiveness can block honest review if they are left unexamined. But when the loss is faced clearly, it can become feedback instead of just discouragement. The aim is not to enjoy being wrong. The aim is to make the experience useful. In investing, a growth mindset means treating skill as improvable. A fixed mindset hears "I lost money" and translates it into "I am not good at this." A growth mindset hears the same outcome and asks what it reveals about the decision process. That shift matters because skill in investing improves through practice, feedback, and adjustment, not through protecting your ego from every setback. Losses become data rather than proof of inadequacy. Curiosity starts to replace self-judgment, and that makes learning much more likely. One of the most important parts of this mindset is separating results from self-worth. A losing trade says something about one decision made in one situation. It does not define your ability, your intelligence, or your value as a person. Say the result plainly and factually. This trade lost 8%, or this thesis did not play out. That kind of language keeps the loss connected to reality instead of identity. Shame makes honest review harder because it turns every mistake into a threat to the self. Clear thinking becomes easier when ego is no longer the thing being defended. A growth mindset also keeps review focused on what you can control. Markets are uncertain, and not every loss was avoidable. What matters is whether your process was sound. Review the quality of your research, your position sizing, your entry price, and your exit plan. Ask whether the trade fit your rules and whether the risk was appropriate. Try not to get stuck on what the market should have done, because that thought rarely improves future decisions. The useful lesson is usually found in your choices, not in your frustration with uncertainty. A simple 5-step review can turn that idea into a routine. First, pause before reacting, so the loss does not immediately drive behavior. Second, separate the result from your identity, and remind yourself that a bad outcome does not make you a bad investor. Third, find one controllable factor, such as research depth, sizing, timing, or exits. Fourth, write one specific lesson instead of a vague promise. And fifth,
Apply that lesson in your next few decisions, so it becomes behavior, not just reflection. The goal is to reduce emotion and capture one practical improvement. The lesson only becomes valuable when it is specific. Saying, "I need to be smarter," feels serious, but it gives you nothing to follow. A better lesson starts with, "Next time I will," and ends with an observable action. You might say, "Next time I will check debt levels before buying," or "I will risk no more than 1% on a single trade," or "I will define my exit before entry."
These are clear enough to repeat and review later. Vague intentions comfort the mind briefly. Concrete rules improve the process.
Priya's example shows the difference. She lost money on a renewable energy stock. But the most useful part of the experience was not the pain of the loss itself. It was the review that followed. She realized she'd relied too heavily on one analyst report, skipped checking the company's debt levels, and entered the trade without a stop loss or exit plan. Those are process issues, not personality flaws. So she turned them into a rule. Use stronger research standards and apply an 8% stop loss. Later, even when another trade did not work, the damage was much smaller because the process had improved. You can practice this with one real trade from your own history. Start by recording the basic facts: what you bought, at what price, why you bought it, and how it ended. Then write your first emotional reaction honestly, whether it was panic, embarrassment, anger, or disappointment. After that, rewrite the experience as a lesson you control, not as a story about your identity. Finally, turn that lesson into one future rule you can actually follow. This exercise matters because it shifts you from reliving the loss to learning from it. Over time, that shift becomes a habit. A growth mindset has its own traps, and it helps to name them. It is not the same as optimism, and it should not become a cheerful excuse for sloppy decisions. It also should not be applied only to winning trades, while losses are ignored. Be careful about blaming outside events too quickly, because that can hide the parts of the process you could improve. And there is a line between reflection and rumination. The point is to review, extract a lesson, create a rule, and move forward. Growth is practical only when it leads to changed behavior. The habit that improves portfolio maintenance is simple, even if it is not always easy. Pause when a loss hurts. Separate your identity from the outcome. Find one controllable factor. Write one specific lesson. Then use it soon, while the insight is still fresh enough to shape behavior. You do not need to like being wrong, and you do not need to pretend losses are pleasant. You only need a process that can turn painful results into better decisions. That is what keeps mistakes from being wasted.